Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The Federal Reserve is facing a very bad cocktail mix of problems, which is going to be extremely difficult to contain. One, U.S. overall credit adjusted for inflation has contracted for the last 3 quarters. 2, asset prices of both bonds and stocks have steadily fallen throughout 2022. 3, the Fed has been forced to increase interest rates even more aggressively than it had planned only a few months ago. And 4, the Fed's consensus terminal rate is now expected to end up being over 5%. The Federal Reserve and U.S. Treasury are only too acutely aware of all of this. So what is their plan? We laid out what we expect in our latest newsletter entitled Watch Yellen, Not Powell. Therefore, we won't address what they will do in detail in this session as much as the boundary conditions they're operating under. The conditions which, as we spelled out in the newsletter, we feel will force Powell, via Janet Yellen's U.S. Treasury, into using off-balance sheet contingent liability loan guarantees to pull off their circuitous plan. As such, we will cover the outlined items shown here. A huge problem Fed Chairman Jerome Powell and U.S. Treasury Secretary Janet Yellen face is the fact the shift from capitalism to creditism is now causing real problems as the shock of COVID-19, lockdowns, supply chain disruptions, and massive global liquidity injections to keep the global economy running are now taking their toll. The shift from capitalism to creditism is best illustrated by the blue and black bars on this graphic. Savings is in blue, which in a capitalistic system is reinvested into productive assets, which has steadily over the years been replaced with credit, which is lost to consumption. However, credit growth in black has been shrinking since the 2008 financial crisis and has been made up by the Fed's quantitative easing in green and until recently by global investment into U.S. Treasury debt, shown in red. The bad cocktail mix is centered around the reality of the Fed's shift from quantitative easing to quantitative tightening, a further U.S. worsening of foreign investment in the buying of U.S. Treasury debt because of one, increasing global de-dollarization as a result of the weaponization of the U.S. dollar through sanctions as a U.S. foreign policy tool. And 2, the U.S. no longer is the exporter it once was, so there is decreasing need for U.S. dollars due to increasing bilateral trade agreements in other currencies. And now, U.S. credit creation is also further weakening at an alarming rate. The net of this is that though capitalism leads to higher standards of living, creditism inevitably leads to lower standards of living. That is what the U.S. and other major developed powers are now facing. When savings are reinvested into productive assets, these assets increase overall national labor productivity, which directly increases standards of living. On the other hand, when savings are small and are substituted for credit, for primarily consumption, it is only a matter of time before standards of living must necessarily fall. This is particularly an aggravating problem within a 70% dependent consumption economy like the U.S. is. The U.S. and many of the developed economies have now reached the point of insufficient and unsustainable credit growth. Let's now more closely examine the elements of this bad cocktail mix. A credit-dependent economic system requires minimal levels of credit growth to avert slowing economic growth and as a consequential crisis. As interest rates rise, credit obviously becomes less affordable. However, when rates truly spike at a fast rate, as they have in 2022, this causes havoc in more than just the credit market, as you will see here in a moment. Credit growth has been increasingly supporting economic growth in the U.S. for decades. This has been particularly so since the U.S. offshored over 52,000 manufacturing facilities with the entry of China into the World Trade Organization in 2002. This dependency has surged from $1 trillion in 1964 to $91 trillion today, a 91-fold increase in 58 short years. What is important to understand is that when credit adjusted for inflation grows by less than 2% a year, the U.S. economy historically goes into economic recession. As shown in the right, credit growth has been noticeably weaker ever since the 2008 financial crisis. Thanks to Chairman Ben Bernanke, when credit growth stalled following the 2008 financial crisis, he used quantitative easing on 4 separate occasions to push asset prices higher. The thinking was that rising asset prices harnessed the wealth effect that supplemented credit growth by boosting consumption and thereby grew the economy. It has temporarily worked, but has left us with some serious and crippling problems. Thanks to the very low interest QE rates, through these 4 QE rounds, household wealth did increase, unfortunately, to a staggering $150 trillion by the end of last year, with an increase of $80 trillion or 114% from the pre-crisis 2007 peak. Once the wealth effect got going, it took on a life of its own as the use of leverage, derivatives, and financial engineering to capture more wealth took over. Now suddenly credit growth, again adjusted for inflation, is contracting at the same time that plunging asset prices are wiping out trillions of dollars of wealth. The increasing wealth was immediately used as collateral to leverage investors' ability to capture further gains. This credit collateral is now being wiped out. I encourage you to Google something called rehypothecation to fully appreciate the broad-based global implications of this. I won't go into it here because it's a long discussion, but it is centrally important in understanding the damage that is wreaked throughout the euro-dollar system. Total credit growth adjusted for inflation has now contracted by 1.7% year over year in the most recent quarter. That is well below the U.S. recession threshold. Credit growth has contracted for 3 quarters in a row, and it's been below 2% for 5 quarters. U.S. household wealth has contracted by $6 trillion during the first half of 2022, but U.S. capitalization has plummeted by over $18 trillion and globally by over $40 trillion. What is additionally seriously problematic, and I have suggested already, is the rate of collapse. Wealth destruction in the second quarter for the household sector was the largest ever recorded, and this was before the housing sector broke as mortgage rates spiked. Even after the sharp correction, asset prices are still stretched by most historical measures. At 778 in Q2 2022, the wealth to income ratio is still 16% above its previous all-time peak of 670 during the property bubble in 2007 and 2008. With the Fed funds rate still being well below the CPI at 40-year highs, the Federal Reserve appears to be well behind the curve. The results of the surge in U.S. rates have been a major unintended consequence around the world. One of the biggest consequences has been the currency movements in almost all major currencies. On the surface, the U.S. dollar has been the biggest beneficiary as a result of a global flight to safety. However, this has set off a chain reaction most evidently in the highly leveraged emerging market economies. That said, it is the currencies of the major developed economies that are receiving the current bulk of attention. Stepping back, we had a fragile global economic state as a result of the COVID-19 global pandemic. This was as a result of COVID lockdowns, a $30 trillion global fiscal stimulus surge, global supply chain bottlenecks, an energy crisis, a sudden Ukraine war and the sanctions that accompanied it, mounting emerging market food shortages globally. The result was a serious, unprecedented jolt to the global economic system as 32 major central banks were then suddenly forced to tighten credit as inflation violently struck. A second shock has also insidiously hit as the rate of increase of U.S. fund rates rose, the rate of increase of real U.S. rates also rose, the rate of increase of the U.S. dollar also rose, all while experiencing a diminishing level of liquidity. The result has been a global cost of and need for hedging. $40 trillion in lost capital, major bond volatility called value at risk, which controls most of the financial institutions and certainly the banking industry, collateral shortages being squeezed, and a spiking dramatic shift in the FRA-OIS rates that measures the risk that banks see between lending overnight to other banks. We're already seeing the fallout of over-leveraged situations. In the UK, with the LDI derivative implosion within the pension sector, with the Swiss National Bank urgently needing 11 billion in US dollar swaps, major spikes in the cost of CDSs for major global players like Credit Suisse, the National Bank of Belgium suddenly in panic mode with the ECB, and I can go on. All of this is resulting in a fractured global derivatives swaps market. This unregulated, over-the-counter global swaps market, which is solely reported on by the highly secretive Bank of International Settlements, has a notional value of over 600 trillion. Let me repeat that number. Over 600 trillion in global cross-border interest rate and currency swaps. Anything that impacts the global swaps market has an exaggerated and nonlinear shock to the global financial systems. Quick moving, high volatility in bond markets and currencies, which is what we're seeing, is a major issue for this market. If the current put-call premium shown here is any indication, and I think it is, we are nearing an institutional panic in the credit and derivatives market. Everyone appears on the side of the boat suggesting a near-term market crash. What this chart also tells us from a contrarian perspective is that this has also proven to have actually been the point of a major market bounce. This may be another ultimate contrarian opportunity. Why? Historically, this is because the powers to be see the imminent problem and are forced into action. Their actions often take the form of changing the rules of the game, or more blatantly, as what I will call simply cheating. We can and should expect the unexpected to soon occur, and in fact may already be occurring behind the curtain. Not for one moment am I suggesting that that action necessarily means an imminent Fed pivot. Yes, the pivot is coming, but it may still be off in the future after other games have been tried in an attempt to buy the Federal Reserve more time. I list those games in our latest newsletter emailed to you or available online at matasii.com. Also, our prior newsletter addressed the issues in the global derivatives market. What do we expect in the near term? You can never know for sure, as we are basically at the hands of unelected bureaucrats. Our long-term dollar chart is telling us we are likely to soon see a retracement in the US dollar. This suggests a bounce would occur. A falling US dollar would take some serious external intervention to occur, similar to the 1985 Plaza Accord, in fact, where the US dollar strength was causing mayhem, similar to today. Long-term bear market patterns suggest we are near a cusp where we either reverse strongly upward or continue rapidly and possibly accelerating downward in a capitulation, both within new trend channels for extended periods of time. This analogy against the 2000-2003 and 2008-2009 bear markets is pretty clear if we are going to see the typical three phases of a bear market. I've shown this chart previously of the long-term earnings breadth. We have already experienced the typical extended anxiety period that precedes a final capitulation stage. All this seems just too obvious, and the markets seldom make anything obvious. What is more obvious, however, is that the powers to be must be considering some serious alternatives in conducting a surprise action. Remember, these will only be tricks that may temporarily lift the market but won't create earnings. Ongoing weakening earnings will eventually prevail. We can't be certain of what will occur, but we can be prepared. What we are, however, certain of is that major bear markets take time. Typically, they are in the range of 16 months and take the markets down 42%. We've only experienced a 9-month decline of 26%. We need to fully understand that the global economy is undergoing major structural upheaval. This takes time to occur. As a consequence, we must expect major changes still lie ahead. Central banks are controlled by what is referred to as the unholy trinity. where they can control only 2 out of 3 critical monetary levers. The levers are a pegged exchange rate, an independent monetary policy, or free capital flows. Most major powers have been operating with the construct of independent monetary policy and free capital flows without a pegged exchange rate. There is every likelihood that if history is any indication, that we will soon see differing changes to a country's preference in their selection of their unholy trinity. Most specifically, we will see this in the foreign exchange interventions to establish targets for their currencies. We're already seeing the following significant actions or possibilities. In U.S. Treasuries, a very active plunge protection team, blatantly evident in the Financial Conditions Index. A $21 billion of U.S. SDRs now being proposed to be transferred to the IMF. Yellen soliciting directly money-centered banks' input on whether buybacks of bonds from them is a possibility or practical, and also the use of contingent liability guarantees to finance breaking problems around the world. Nationalization, we're seeing that in Germany through most recently an energy broker, in France through the nuclear energy, and we can expect more of that. We expect to see capital controls within 12 months starting to prevail, and the possibility of more forced yield curve control, though that is now turning out to be an utter failure in Japan. My 3 suggestions to you are: 1. Don't listen to what the Fed says. Focus only on what they actually do. 2. Watch U.S. Treasury Secretary Yellen much closer than Chairman Jerome Powell for indications of what the powers to be are really up to. 3rd, monitor closely the U.S. dollar and U.S. real rate activity. These are the charts to have on your trading screens. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder: do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.